In just over a decade, cryptocurrencies have grown from digital novelties to trillion-dollar technologies. But despite their massive value, investors face risks such as theft and loss. Regulatory bodies have shown an increasing commitment to fostering a secure and transparent crypto ecosystem. 2024 will see them refine existing frameworks and introduce comprehensive regulations. United States. In the United States, lawmakers have weighed new crypto legislation over the past year. Two bills have emerged that seek to regulate stablecoins and take a comprehensive approach to crypto's market structure. Both of these bills have advanced out of the House Financial Services Committee and face a tough road ahead. The election cycle could play a role in the legislation's fate. Some of the potential regulations include establishing clear tax guidelines, creating regulatory sandboxes for innovation, and establishing disclosure standards for investors. In addition, the SEC might adopt more stringent anti-fraud and price manipulation measures. Lastly, crypto lending and decentralized finance, DeFi, platforms could be subjected to stricter licensing requirements. The EU's MiCA regulation will come into effect in mid-2024, which could also boost consumer protection and investor confidence. Additionally, a UK law known as the Travel Rule will require virtual asset service providers to provide information about their customers to combat money laundering and terrorist financing risks. Consistent crypto regulations across multiple jurisdictions benefit consumers by ensuring that companies are held to a higher standard. This is also a key aspect of the MiCA regulation in the EU, which has set an important precedent for other countries to follow. Canada. In the past year, Canadian securities regulators have made some progress in categorizing crypto assets and imposing regulation. They are now requiring exchanges that trade cryptos to register and implement protections against market manipulation, fraud, and more. In addition, they are implementing rules to limit the exposure of public investment funds to crypto assets. The CRA's current position on cryptocurrencies is that they are not currencies for income tax purposes. Instead, they are akin to commodities, such as precious metals and publicly traded securities. They are also subject to sales taxes, just like other tangible property. Therefore, businesses that purchase or sell cryptocurrency should understand the sales tax implications. Likewise, businesses that mine or stake cryptos must understand the tax implications of their activities. For example, CRA treats mining or staking as either a personal activity or a business and evaluates each case on an individual basis. The CRA also requires that companies value their inventory at cost or fair market value, FMV, whichever is lower. It is important to consult with a crypto tax specialist before making any decisions regarding these matters. In addition, the CRA should be consulted for guidance on how to report cryptocurrency earnings and expenses. Brazil. In a milestone move that reflects global trends towards regulated digital assets, Brazil is set to impose taxes on cryptocurrency earnings held on foreign exchanges. Earlier this year, the governor of Brazil's central bank outlined plans to tighten up on crypto trading regulations in a bid to prevent tax evasion. This new legislation will see citizens pay up to 15% of their earnings from foreign-based cryptocurrency exchanges, up from the current 8% rate. It will apply to both individual investors and exclusive funds, investment funds with a single shareholder, as well as to companies active in the Brazilian financial market. The legislative change is expected to come into force in early 2024, with VASPs required to register with the Council for Financial Activities Conselho de Controle de Atividades Financeiras, or COF, and keep customer records. This will enable BCB to monitor and enforce anti-money laundering and fighting the financing of terrorism, AML/CFT, rules. VASPs will also be required to report suspicious transactions to COF. This will put the new law in line with other existing anti-money laundering and countering the financing of terrorism regulations. However, some senators, including Rogério Marinho, have voiced their opposition to the bill. Singapore. The Singapore government has been a pioneer when it comes to cryptocurrency regulations. The country's Financial Services Act and Payment Services Act regulate the sale, purchase and trading of digital currencies in the region. This includes the requirement to adhere to anti-money laundering and countering the financing of terrorism, AML/CFT, rules. In addition, the country has a robust advertising regulation and has banned crypto firms from promoting their services via public areas or third-party influencers. Earlier this year, the Monetary Authority of Singapore outlined a set of proposed measures designed to manage the growing risks and opportunities associated with digital assets. The city-state central bank and financial regulator, MOS, said the drafted controls would limit potential consumer harm, including banning credit lines from being used to buy volatile digital assets. The measures will be rolled out in phases starting from mid-2024. The new rules will also require DPT service providers to publish their governing policies and establish procedures for resolving disputes. In addition, the DPT platforms will be required to identify, mitigate and disclose conflicts of interest. They will also be required to assess the risk awareness of their customers before allowing them access to the DPT market. France. The French regulator of financial markets, the AMF, is set to require digital asset service providers that operate in France to adhere to a new set of registration requirements that are much more robust than what they have to offer now. The change will take effect January 1, 2024, and will force newcomers to the crypto market to comply with this new set of conditions that have been deemed necessary by MiCA, markets in crypto assets. This new registration regime aims to ensure better governance, rules on the segregation of funds, and a policy for conflict of interests. Many of these provisions overlap with those outlined in the EU's upcoming regulatory framework that will likely be passed in April. The move will help to make France a more attractive location for crypto players, as it has been able to attract established financial companies like Société Générale that launched a stablecoin there. It will also ensure that companies like Coinbase can passport their services into other European countries that are governed by the same framework. United Arab Emirates. As 2023 came to a close, major jurisdictions from Europe to Asia exhibited renewed commitment to fostering a robust crypto industry that supports numerous use cases. This is evidenced by the fact that regulators are holding crypto market participants to high standards while simultaneously implementing comprehensive laws to prevent bad actors from operating in the space. In the UAE, the federal government of the Federation of Seven Emirates along the eastern shore of the Arabian Peninsula has stepped up its efforts to regulate digital assets. As such, the country has become one of the top jurisdictions for firms seeking legal clarity in this emerging industry. Its recent updates to its anti-money laundering (AML) and countering the financing of terrorism rules have added greater transparency and stricter compliance for companies dealing with digital assets. The UK's early implementation of travel rule requirements and the UAE's addition of these requirements to its AML/CTF laws highlight the broader trend towards transactional transparency across the global financial services industry. Moreover, the UAE's clear regulatory framework has drawn the attention of big-name cryptocurrency firms, including Coma Inu, OKX and Binance, which have signaled interest in opening offices there. In addition, the central banks of the UAE and Hong Kong recently met to discuss ways to strengthen their cooperation on crypto regulations. Hong Kong. The Hong Kong Securities and Futures Commission, SFC, has outlined the requirements for companies to launch virtual asset trading platforms in Hong Kong. The new rules impose strict standards for the management of these businesses, including the use of regulated individuals who have passed a thorough fit and proper assessment. They must also have at least one director with a background in financial services. The SFC has also set out the criteria for determining whether non-security tokens are regarded as securities and should be regulated under Hong Kong law. In addition, it will require a VAT to publish its financial reports and conduct due diligence on any third-party provider it contracts with. It will also be required to maintain a record of all transactions with the public and provide its reports to SFC inspectors. As Hong Kong regulators work to establish the city as a Web3 hub, it seems clear that they are taking a progressive approach towards crypto regulation. This is a stark contrast to mainland China, which has taken a hardline stance on the sector. The move also follows a string of crypto winter disasters, such as the collapse of Terra Luna stablecoin and the bankruptcy of FTX.